Good afternoon, partners and colleagues. I hope everyone has been keeping safe, healthy, and well despite these challenging times. And welcome to this learning session for rural and cooperative banks and thrift banks on the basics of climate-related risks, hosted in collaboration with the Banko Sentral ng Pilipinas or BSP. So I'm checking the number of participants. We now have more than 400 stakeholders across more than 200 organizations. And so this really indicates the high level of interest from our stakeholders. I am Marlon Joseph Apanyada, Strategic Advisor to Allotrope Partners and convener of the Greening the Banks initiative. I am honored to host and moderate today's timely and much anticipated webinar and learn more about the fundamentals of climate-related risks from our expert speakers in the Philippines and the region. We start today's program with an introduction to the Greening the Banks initiative, to be followed by welcoming remarks from BSP's Deputy Governor, Ms. Chuchi Fanasher, which I'm very excited to hear about, as this may be one of the first public webinars for this year. This will then be followed by a presentation on the first of two climate-related risks 101s. This time with a focus on physical risks, to be delivered by Mr. Firdaus Anwar, Project Manager for the Asia Investor Group on Climate Change. We will then hear from Mr. Upendra Podial, the Asia Pacific representative of the Global Alliance for Banking on Values, or GABV, to discuss climate-related risks 101 with a focus now on transition risks. Our final resource person will discuss a case study examples of bank responses to climate-related events, and this will be delivered by Dr. Jaime Aris Alip, founder and chairman of the Center for Agriculture and Rural Development, Mutually Reinforcing Institutions, or CARD-MRI. We will end our webinar with an open forum, so please feel free to send in your questions in the Q&A box at any point during the program. This event will be recorded and posted on Allotrope Partners' YouTube page and website for future reference. Next slide, please. Greening the Banks, or GTB, is led by Allotrope Partners, a clean energy advisory firm headquartered in the United States with on-the-ground staff operating across Southeast Asia, including the Philippines. Allotrope leads several initiatives in the corporate RE advisory sector in the Philippines, including the Clean Energy Investment Accelerator and Greening the Banks initiative. Next slide, please. So Greening the Banks was launched in the Philippines in 2019, and it seeks to build the capacity of Southeast Asian public and private sector financial institutions to actively participate in green finance. Through GTB, we are engaging with the different stakeholders to bridge the gap among banks, regulators, developers, and civil society organizations to unlock scaled green investments in the region by facilitating in-country dialogues among FIs, project developers, financial regulators, and other stakeholders, while proactively collaborating with global, regional, and local initiatives with shared objectives, such as the Asia Investor Group on climate change, the Global Alliance, the GABV, and CARD-MRI. Greening the Banks leverages the experience and expertise of the Allotrope Partners team in emerging markets to be able to address these gaps and make sure that these high-level global and regional principles are actually being taken up and implemented on the ground, and make sure these actions are actually contributing to transformative change. So next slide, please. Since our launch in 2019, we have been able to cultivate and build a coalition of sustainability finance leaders in the Philippines. And in the past year, we've had the opportunity to design and host, in collaboration with the BSP and expert speakers, a series of dialogues on climate-related physical and transition risks and green finance challenges and opportunities. Through these webinars, we've been able to engage over 550 participants representing more than 160 commercial, rural, cooperative, and local banks across the Philippines, along with a range of other energy and finance stakeholders. Next slide, please. We held a webinar with more than 400 financial leaders representing 130 organizations. And an important takeaway from this convening, not surprisingly, is that extreme weather events negatively affect banks' loan growth and deposit growth, especially for rural and cooperative banks. This emphasizes the urgent need to increase banks' familiarity with climate-related physical risks and transition risks, and build their capacity to assess these risks and integrate physical risks into risk management frameworks. So next slide, please. In another webinar, we also focus our discussion on transition risks with Philippine commercial and universal banks. Our speakers indicated that even if the bank has no direct exposure to the fossil fuel industry, the energy transition, being systemic in nature, could trigger a chain reaction that might positively or negatively impact the performance and viability of various loan and investment portfolios. As with physical risks, successfully managing transition risks provides opportunities for the banks as well as provide brand and reputational advantages. Next slide, please. So we continue to create this community of champions and resource and expert speakers, and we learned that in this area, 3 action points on managing climate-related transition risks, which may be relevant even for managing physical risks, were highlighted as follows: fact-finding, building internal capacity and awareness of climate risks, and initiating dialogues with key clients on sustainability as early as possible. So next slide, please. So this convening today, and thank you for joining us, really builds upon the progress of these previous webinars, and as informed by the numerous requests that the BSP has received from its stakeholders. This dialogue series aims to serve as an opportunity to engage rural and cooperative banks and thrift banks on the basics of climate-related risks and how these risks could affect their operations, your operations. So we hope that through this webinar, in collaboration with the BSP, and through the lessons that we will learn from our esteemed panel of resource speakers, we can achieve these objectives, as you can see on the screen, and ultimately support our participating banks in the continuous pursuit to maintaining financial stability, as well as advancing climate preparedness and sustainability in the Philippines. With this, we now proceed with the program proper, starting with our welcome remarks to be delivered by BSP Deputy Governor, Ms. Chuchi Fonasher. Ms. Chuchi G. Fonasher is the Deputy Governor of the Financial Supervision Sector, or FSS, which is mainly responsible for the regulation of banks and other BSP-supervised financial institutions. Let's welcome, with an online round of applause, Banko Sentral ng Pilipinas Deputy Governor Chuchi Fonasher for her welcoming remarks.
So, fellow speakers,
yes, DJ Chuchi,
yeah. So can you hear me? Okay. Fellow speakers, partners, participants, a pleasant afternoon. I am grateful to welcome you all to another Greening the Banks virtual learning series made possible through the collaboration of the Banko Sentral and the Allotrope partners. Today, we are joined by 589 participants from 207 thrift, rural, and cooperative banks across the country. I would like to thank Allotrope partners for co-organizing and hosting this event and supporting the BSP Sustainable Finance journey. Last year, we completed 3 successful virtual workshops. The first two aim to enhance the banking industry's awareness and understanding of physical and transition risks. The third was intended to support the BSP stock-taking exercise relative to its sustainable central banking strategic program. We aim to continue this learning journey with the industry, recognizing the rapid developments in the local and global climate discussions and the vital need for practical knowledge and skills to effectively integrate this into our business operations. Following the launching of the Sustainable Finance Framework in April of 2020, the BSP issued Circular Number 1128 on the Environmental and Social Risk Management Framework in October last year to provide more granular expectations and guidance in managing environmental and social risks relative to credit and operational risks. Barely 2 months ago, Typhoon Odette wreaked havoc in the Visayas and Mindanao regions, damaging more than 13.3 billion worth of agricultural goods, as estimated by the Department of Agriculture. It affected around 533,000 farmers and fisher folks and lost almost 300,000 metric tons of production. During natural disasters such as Typhoon Odette and Typhoon Haiyan in 2013, many facilities and infrastructures, including bank premises, also sustained damages and experienced operational disruptions. And according to the Department of Finance, the damages caused by climate-induced hazards to Philippine infrastructure cost 463 billion from 2010 to 2019. In 2020 alone, the damages reached 113.4 billion. And in light of the many catastrophic events experienced, the BSP expects banks to assess the vulnerability of their offices to the impact of climate change or natural hazards and consider the results in the enhancements of their business continuity plans and other measures supporting banking operations. Likewise, banks should also assess the location of collaterals or income sources of borrowers to better measure and manage credit risk exposures. But climate change risks do not manifest only through physical means. In the recently concluded 2021 United Nations Conference of Parties, or the COP26, held from end October to mid-November last year, the Philippines emphasized its intention to move ahead with urgency in cutting its greenhouse gas emissions through localized climate change interventions and transition from coal to clean energy. It is noteworthy to mention that we are guided by the country's climate goals. In particular, the country submitted in April 2021 its nationally determined contributions, or the NDC, committing to reduce greenhouse gas emissions by 75% by the year 2030. And this was followed by the development and launching of the Philippine Sustainable Finance Roadmap and Guiding Principles in October of 2021, which are key initiatives of the Interagency Technical Working Group on Sustainable Finance, or the Green Force. And these milestones set out the national government's high-level action plans to support the transition to a sustainable economy and address climate change and other environmental risks. As a country that is 57% coal dependent, an abrupt and unplanned change in government policy, technology, and consumer preference to shift from coal to renewable energy sources may significantly disrupt different sectors of the economy. And this is especially true for those that significantly comprise the entire coal value chain. While thrift, rural, and cooperative banks generally have meager exposures to high carbon emitting industries, their exposures to businesses that are part of the entire supply chain suggests that they are not impervious from the potential impacts of climate-related transition risks. It is indeed crucial that we understand the climate change risks we are facing, and this will equip and enable banks to design properly their strategic response and manage effectively the related physical and transition risks, as well as identify the opportunities in this space. This afternoon, we are honored to have distinguished experts and thought leaders to share their rich knowledge and experience on climate-related risks. Thank you for joining us today. I am confident that the dialogues will be truly engaging and insightful. I enjoin all participants to join the discussions actively. And on this note, I wish this event a success. Thank you and good afternoon.
Thank you, DG Chuchi Fonashare, for such an engaging and insightful welcoming remarks, and for really situating where we are at right now, especially for our participants today. It's not only that climate-induced hazards in 2020 alone comprised about a quarter of what was the impact in the years of 2010 to 2019. It's also that they might have and they will have exposure to businesses in the supply chain that are also exposed to transition risks. So thank you so much for such an illuminating opening remarks. And these are the kinds of statements that we really needed to hear and to be reminded of as we all embark on this journey. So thank you, DG, for the share. Thank you, and that's one of the reasons why we've also made a recording of this convening, because the salient points from DG Fonashare's welcoming remarks are those things that we need to really take note of and be reminded on what is at stake for our various organizations. So with that, we now move on to our resource persons. And this afternoon, we have three truly amazing speakers that have kindly joined us today from various parts of the world. Before we proceed, we would like to remind you that you can send in your questions for the open forum at any point during the presentations. With that, we welcome our first speaker to talk about Climate-Related Risks 101, Focus on Physical Risks, to be delivered by Mr. Firdaus Anwar. Firdaus is the project manager for the Asia Investor Group on Climate Change, or AIGCC, and has provided oversight and project support for investor engagement and market outreach activities for AIGCC, especially those in Japan and Southeast Asia. This includes bringing international initiatives into Asian markets to build capacity in the region. So Firdaus, the virtual floor is yours.
Thank you, Marlon, for the introduction, and thank you, Allotrope partners, for inviting me to the event. Let me share my screen. I hope you can see the screen now clearly. Okay, so as an introduction, first of all, a very good afternoon to all participants of this event, and also good afternoon to the rest of the expert speakers, Mr. Podial and Dr. Jaime. So maybe just a little bit of a basic introduction of myself. My name is Firdaus Anwar. I'm a project manager for Asia Investors on Climate Change, currently based in Tokyo. I'm originally a Malaysian from Kuala Lumpur, Malaysia, but I've been living in Japan since the past 13 years and currently working in AIGCC as a project manager to build the capacity on climate change for investors in the region. So maybe we'll start with the next slide. So for the contents of my presentation today, we'll start with divide into 3 sections, where the first one, I'll do a bit of introduction to AIGCC, I mean, who we are and what are kind of activities that we do to build the capacity in the Asia region. And also the second part on, we go deep into the climate related physical risk, where I will focus on my session today, where we will talk about go from the basic of difference between weather and climate change, and also the climate related physical risk in Asia and the Philippines. And also then we go look into what are the things that relates to the physical risk and addressing them, especially into the banking sector. And then on the third one, I will roughly introduce the previous works by AIGCC and other networks, other investors networks related to the physical risk. Sorry. Okay, so the first part for my session today is the introduction into AIGCC. So AIGCC is Asia Investor Group on Climate Change. We are actually an initiative to create awareness and encourage action among Asia's asset owners and financial institutions about the risks and opportunities associated with climate change and low carbon investing. So it is, I think it's very important to say here that all my opinions and perspective today will be kept from asset management and also asset owners industry, more into the investors perspective rather than banking perspective, because that's what we are. And also, I would like to keep it a very high level discussion, so more into the main topics of today's event, which kept at a very 101 level. So then we go to AIGCC. So we are non-profit. We consist of more than 50 asset owners and managers from 13 markets in Asia regions, which includes Japan, for example, Singapore, Hong Kong, Taiwan, and also a bit of Australia. And total up, our members consist of holding of more than 35 trillion USD asset under management as per December last year. So we are building investors' capacity on climate change, and as been listed in the slide here, these are type of examples of what kind of activities that AIGCC been doing in the past years to build the capacity, to build investors' capacity on climate change. And the diagram on this slide shows the relationship between different international initiatives and also regional stakeholders like the Sustainable Investment Forums, for example, and also some policymakers and financial regulators, and also stock exchanges that very much are very important stakeholders when we mention about asset management and asset owners industry. So next, we go to the climate, the topic for today, which is the climate-related physical risks. As an overview, I think it is when we talk about physical risk and also climate risk in a whole, I think it's very important to first understand what is the difference between weather and climate change. And although I'm pretty sure that that everyone, all participants are already very much aware and understand what is the difference between weather and climate change. But just maybe a basic go through the weather change is we can consider it as any short-term change in the atmosphere, like for example, when there's temperature changes, there are rainstorms, some big heat waves, and typhoons, for example. And then there's also individual events where, like when the typhoon come, or maybe when there's an occurrence of volcanoes and disasters, those will be considered as an individual event. And when we mention about climate change is, on the other hand, is a change in the long-term weather patterns, which means it's typically average over a period of 30 years. Like, for example, when the temperature are like during different seasons, like how much it rains, how much it snows, and these changes in climate, changes in the long-term weather patterns will change the individual events as well. So climate change, as you see on the slides, is it will be indicated in increase in the occurrence of the typhoons or hurricanes, in the higher rainfall, for example, and also more intense, more proportion of such individual events. So that will be the difference between weather and climate change. Okay, next, maybe we go into the Philippines climate risk profile. I've been living in Japan, and I find Japan and Philippines are very much very disaster prone, as we all very understand and very aware of that. Philippines as well. The slide here showed from the USAID, where they provide a climate risk profile for Philippines that shows which province that have a very high climate risk profile and compared to very low climate risk profile. And we see that it's almost high and very high almost everywhere. And according to USAID, the predicted future climate for Philippines, that the changes in climates by 2050 will include the increased temperature from 1.8 degrees Celsius to 2.2 degrees Celsius. So that's quite a significant increase in the temperature. And also there's a reduced rainfall in most areas from March to May, that making the dry season drier, for example. And also there will be increased heavy and extreme rainfall in Luzon and Visayas during the southwest monsoon, making the wet season more wetter, and decreasing rainfall trends for most of Mindanao. So there will be some changes from the north and also changes in the south as well. And this increased frequency of extreme weather events will include days exceeding 35 degrees Celsius, days with less than 2.5 millimeter of rain. So there will be like some areas with more rains and some areas with less rains. And with all this climate projection, there will be a rising sea levels of 0.48 to 0.65 meters by 2100. So this is the kind of climate projections that have been predicted by USAID. And of course, there will be more climate projection for other countries as well. And as we already understand that Philippines as countries that are disaster-prone countries, the climate change will only increase the risk profile and make the region more prone to disasters going forward. I mean, in the future. Next, I will touch a bit on the topic. We start to go deep into the topic that my session today is, which is about physical risk. We have seen the climate risk profile from the region. So what should we do and how we should handle that, that will come after the slides. So when we mention about physical risk is, of course, can be defined as a global temperature rise for any magnitude, lead to the physical climate impacts that will need to be identified, prepared for, and responded to. So this responds to the meaning behind physical risk when we mention about climate change. Also, for when I mentioned that I come from investor background, so I can only comment from investors' capacity. So when we mention about physical risk and the kind of opportunities is physical climate hazards can impact corporate performance either directly or indirectly, and these kind of things will impact the financial institution as a whole when we mention about the supply chain risk and so forth. So this figure here in the slide shows what kind of the transmission channels for environment and the climate related risk to the financial risk. So how how climate risk will impact the financial institution as a whole. And I think this is a very useful diagram when we're going to talk about how climate risk will be projected to financial risk as a whole. So, so the physical risk you see on the pink box in the bottom, where it includes chronic and also acute level types of physical risk, which I will mention in the next few slides, and also about the transition risk, another type of climate risk that will be explained by Mr. Podial after this. So as mentioned that with me coming from the investors background, and when we try to approach, try to build capacity among investors on how they should address the physical risk in their investment portfolios. So we bring up this kind of investment case where how important physical risk to be addressed within their investment portfolios. Like for example, here, according to McKinsey and Swiss Re, the Indonesia, Malaysia, Philippines, Singapore, and Thailand will lose like 7 times of their GDP, for example, by 2050. And this GDP is based on 2019 figure. And also Asia GDP on the whole will be down by 26.5% by 2048. For example, if we don't properly address physical risk in our region. And also labor productivity will decrease by maximum 12% across regions exposed to high heat and humidity. Like for example, when we mentioned about Philippines climate risk profile just now, where there's a region will experience droughts and also high heat, for example, this will reduce the labor productivity based on the research, and also the real asset damage cost will increase by twice to $14.2 billion by 2050. These are kind of example and investment case when we try to approach the importance of physical risk to be addressed by financial institutions. So in the previous slides, I mentioned about how we can categorize physical risk towards the financial industry as a whole. We can say that physical risk can be categorized into 2 types, which first is the acute events, and another one is chronic events. So acute events refers to the more frequent and more intense weather events. So it can directly impact assets in the form of damages to physical assets, disruptions in the supply chain, and also disruption in infrastructure and also utilities. So some example here, of course, which I believe everyone will be familiar with, the Haiyan or Typhoon Yolanda in the Philippines in 2013, where the impact to the Philippines resulted over 6,300 fatalities and impacted many families across 14 provinces, and the total damage and losses of an estimated to $12.9 billion. So this is a kind of impact from acute events that the changes, the individual weather events that resulted from changes in climate that impact directly to the real estate and also to supply chain and infrastructure and utilities. And the next one, the second type of physical risk, when we mention physical risk, is about chronic changes. Chronic changes refers to long-term sustained changes to the physical environment due to the climate change. So on contrast to acute events, that refers to event where it impacted the physical assets, chronic changes refers to something that comes in a long time, which is progressive and it's not being felt immediately. The effect can be cumulative, which means it will add up and create something bigger. It started small and then it become bigger, and this impact the financial performance of something. Yeah. So rising sea levels, for example, increasing temperatures, for example, and changes in precipitation patterns where more rainfall less rainfall. Also the scarcity of fresh water, for example, this will such an example for chronic changes of physical risk, and such financial impacts will include a change in revenue. Like for example, when there's less precipitation, there will be a decreased output of something. There's also some change in climate would bring opportunities, for example, and also might increase some revenue, but there's also could be a negative effect from that. And also there's a changes in cost of production, for example, where the reduced availability of natural resources that impacted from these events, increasing material costs and logistic costs. And also due to this progressive cumulative event that will also impacted asset impairment and devaluation of assets. So this kind of example where the chronic changes of physical risks will impact the financial industry as a whole. So we're going close. I'm conscious of the time. I will introduce some works by AIGCC and also other investors networks that relates to our topics today about physical risk of climate change. The first one is our report, AIGCC report that we published last year in October, slightly before the COP event in Edinburgh. So this report, which is titled Riding the Wave of Physical Risks, which is a compendium of tools and service providers for investors in Asia, where this report, we compile 18 service providers that provide the tools where the investors can use to measure the physical risk of their portfolios, for example. So we also provide 5 case studies of Asian tilted portfolios across multiple asset classes. And this compendium includes a level of analysis, what kind of Asia coverage, and what are the tools that are available out there for Asian investors to measure and to mitigate the physical risk in their portfolios. So this has been getting quite a lot of attention because when one of our working groups in AIGCC is the one that behind the publishment of this report, where many investors mentioned that we know that physical risk is important and it is needed to address the climate risk in our portfolios, but what we can do and what are the tools available out there. So it's kind of separated. And so this report is hoping that we can provide the information, that one-stop information to these investors, that what are the available tools that they can use out there. So the next report, I guess, is more related to the banking sector. It's by Series. Series is also one of our investors network in North America, in the US, for example, where Series is a much larger organization. They have produced an analysis to show that how important to address climate risk for banks in the US. So this report, which is published on last year as well in September, is a more focus on physical climate risk for banks. And although this report is specifically refers and focus on the American banks, but it provides some illustrative picture of what banks should address physical risks in their operation, for example, and what are some kind of recommendations from Series to guide the banking industry to fully measure, analyze, and acting against threats posed by the physical risks of climate change. And I think this is a very useful resources that are being available out there that can be referred to. And I'm happy to answer any questions or maybe any any further questions that relates to this and what we can help the banking sector in the Philippines going forward, for example. So that's the end of my presentation today. Thank you so much for listening and looking forward to the discussion. Thank you so much.
Thank you so much, Firdaus, for such an impressive and comprehensive presentation. We invite everyone to use the Q&A box if you have specific questions to Firdaus. Especially enlightening were his insights on the acute and chronic changes from climate-related risks. And as we relay the takeaways from this presentation, we will make sure that we include the links for those two reports covering Asia investors and US banks that Firdaus shared. So in the interest of time, we really encourage you to use the Q&A box for specific questions on the presentations from Firdaus. But Firdaus, thank you so much for joining us, and truly encouraging to see the broad swaths of work that AIGCC has already done. Thank you. So from physical risks, we now move on to our next speaker, who will discuss climate-related risks 101, but a focus on transition risks. We have Mr. Upendra Podyal to give us his insights and share his knowledge. Upendra has more than 3 decades of experience in the banking and finance sector, and he is currently the Asia-Pacific representative of the Global Alliance for Banking on Values, or GABV. He is also currently the chairman of the board of Nabil Bank Limited in Nepal. Please go ahead, Upendra, and let's give him a round of virtual applause.
Thank you, Marlon. It's really an opportunity for me to speak to such a big crowd from Philippines, not also from the banking sector. I would like to greet all of you, all of the participants and resource persons and participants from Central Bank and the organizers. I represent Global Alliance for Banking on Values, which is headquartered in Netherlands, but I'm based in Kathmandu, Nepal. This Global Alliance is a network of global banking leaders, right from Latin America to Asia, North America, and Europe and Africa. So it's a global network of the banks who are actually involved in sustainable banking practices. So it's a magnificent group of people when we meet annually in our annual general meetings. So let me move on to my presentation now. If you could, next slide, please. This climate change, right from Paris Agreement and COP26, climate change has been recognized as one of the biggest challenges we face today, with developing countries, including Philippines, being the most impacted, as also highlighted by Firdaus. There is an urgent need for investment to enable all sectors of the economy, more importantly, the vulnerable communities and ecosystem, to adapt to and mitigate climate change. However, there is a lack of awareness, capacity, and funding for the much needed transitioning towards renewable energies and green finance, particularly in this part of the world. Among the many examples of climate finance transition in developed nations, I used to make a reference of Germany as an example. Renewable energy in Germany, which was around 18% back in 2019, has now improved significantly to 46% in 2019 and is growing steadily. This has been possible because of their serious efforts to phase out of nuclear energy as well as coal-fired power plants. There has been strong renewable energies. There has been a strong commitment at all levels in Germany for this in this process, from the people as well as the financial institutions and the government. While this is so, developing countries like us still need to go a long way in this process. Fossil fuel in our part of the world continues to dominate the consumption pattern, and the expansion of renewable energies in developing countries is progressing very, very slowly. At the same time, energy consumption in emerging countries like us, including China, India, and booming economies of Southeast Asia, as well as developing countries in Latin America and African countries, the energy consumption is growing rapidly. Therefore, we do not have any doubt that there is an absolute need for an enhanced focus for transition to a low carbon economy for sustainable economic development. We must work towards accelerating the transition to greener economies, for which we must increase investments in climate-friendly and green projects in order to catch up with the transformation needs which is required by various conventions. Let me talk about what transaction risk is. Transaction risk is the risk to be inherited in changing strategies, policies, or investments as society and industry work to reduce its reliance on carbon and impact on the climate. Even the Bank of England has also noted that transition risk can occur when moving towards a less polluting, greener economy. Such transitions could mean that some sectors of the economy face big shifts in assets value or higher costs of doing business. As of now, we have focused more on direct physical risk of climate change. However, apart from physical risk, as a result of climate change, transition risk has been lately recognized as a major risk. It is argued that ignoring the risk of transition to low carbon even can threaten financial stability across the economies globally. Business entities, therefore, and the financial institutions must therefore act urgently in addressing transition risks. Next slide, please. Let me now talk about the impact of transition to the low carbon economies across the globe. Here, consumers would face additional upfront capital costs and need to spend more in near term on electricity. The transition would also affect consumer spending. Demand for low emissions goods and services would increase and lower demand for high emission ones, in turn causing changes across value chains. Will require significant capital spending on the formation of new physical assets and the transformation of existing ones. Operating and production costs would change as low emissions processes are implemented, investment is made, and energy consumption shifts towards low emission sources. There will be impact on jobs as well. Workforce requirements would evolve as markets are reshaped and organizations bring about new operational practices and processes which may lead to need for economic and societal adjustments during the transition. Again, consumers' spending habit may be affected by decarbonization efforts. For example, they may need to replace goods that burn fossil fuels like transportation vehicles, which we have already started, home heating systems, cooking system. Further, any rise in electricity prices would affect consumers, particularly the low-income consumers whom our type of institutions are actually dealing with. Consumers would incur upfront capital costs related in particular to the mobility and even building transitions. Higher production costs could also affect price of consumer goods and services in other areas. In fact, the supply may not be able to scale up sufficiently, resulting in shortage and price increases, and that will create volatility in the market. Rapidly scaling up demand for low emissions assets and other products needed for transition would correspondingly scale up supply, and that could lead to supply-demand imbalances, shortage, price increases, and inflation. And what would it mean for agriculture-based countries like Philippines? These countries, agriculture is the primary source of employment and income for a large share of population in agriculture-based countries. An important adjustment for these countries will be adopting low emission farming practices, which I'm sure all of us have started doing it, impacting on millions of people. These countries are expected to invest substantially in new assets as they grow their economies, particularly related to the power sector. These countries also have significant potential to produce solar power and use forest land to generate carbon credits. Likewise, challenges would compound for many lower income and fossil fuel producing countries, which would need to balance multiple factors. When we talk of transition in banking, we know banking touches lives of all, and proper use of its resources is crucial to sustainable economic development. Ability of financing would be a key priority for the transition. As such, financial sector has a greater role to play for transition to a lower carbon economy. Their investment decisions must consider the impact of both environmental and social risks on the financial system and the impact of the financial system on environmental and social risks. However, the banks are exposed to immense risk, which we must identify, measure, and address and mitigate it. Can we move on to the next slide, please? When talking of types of transaction risks, we have four types of, broadly, we have four types of transition risks: policy and legal, technology risk, market risk, reputation risk. We all have policy risks arising from change in regulation and legal risks from climate-related liability. There is technology risk that is caused by emerging technologies that will challenge the current ways of doing things. We also face market risk due to changing supply and demand and changing customer preferences. So businesses are going to have to be prepared to manage under the changing environment. And of course, there is a reputation risk. Can we move on to another slide, please? Let me just give you some examples of climate-related risks and potential financial impacts. Policy actions will be required to control adverse effects of climate change as well as to promote adaptation to climate change. Some examples include implementing carbon pricing mechanisms to reduce GHG emissions, shifting energy use towards lower emission sources, adopting energy efficiency solutions, encouraging greater water efficiency measures, which is very crucial for us, and promoting more sustainable land use practices. As the value of loss and damage arising from climate change grows, litigation risk is also likely to increase, which has already started in many countries. As a result of these factors, cost to the banks and customer can increase their operating costs for compliance, including insurance, write-offs, and asset impairments is something which is a likely kind of situation. Technological improvements as required will have a significant impact on bank and its customers. For example, the development and use of emerging technologies such as renewable energy, battery storage, energy efficiency, and carbon capture and storage and transportation will affect the competitiveness of the businesses, their production and distribution costs, and ultimately the demand for their products and services. These factors would require the companies incur capital costs. Write-offs can arise because of the existing assets being obsolete, and then it can result in additional costs, ultimately impacting on the viability of the businesses and their repayment capacity. This is something which is of prime importance for us as a banking institution. While the ways in which markets could be affected by climate change, it is varied and complex. There is a risk of shifts in supply and demand for certain commodities, products, and services due to change in consumer behavior. There can be financial implications impacting due to change in costs, including raw materials, which can affect competitiveness of the bank's customers. This has been discussed in more details in the impacts there. These factors will have significant impact on demand and supply, resulting in price volatility in the market. Climate change again can have. Can we move on to the next slide, please? Climate change can be a major source of reputation risk due chiefly to changing customers or community perceptions of an organization's role in the transition to lower carbon economy. The banks and its customers can face negative stakeholders' feedback. This can have negative impacts on revenues and costs. As far as reputation risk is concerned, it's of prime importance for banking institutions, and even for its customers, reputation can have impact on banks' profitability and banks' viability. Can we move on to the next slide, please? As all of these factors ultimately translate to various consequences within the banks and viability of the customers, impacting on the repayment capability as a result of events of defaults and loan losses could arise. As we move towards low carbon economy, managing and mitigating the risks from transition require proactive actions on the part of the banks and careful analysis of the risks and impacts within the banks as well as all other stakeholders, more importantly, the customers. In fact, financial institutions can support large-scale capital reallocation even as they manage their individual risks and opportunities. Relevant practice phase and financial institutions need to consider assessing and disclosing climate risk as the banks are required to conduct climate risk assessments. In fact, many of the banking institutions worldwide, they have signed off with the Partnership for Climate Accounting Financial PCAF for measuring and disclosing climate risks. In fact, Nepal's central bank introduced the environmental impact assessment requirement for the banks back in 2018, and that has been now converted as the directive just last year. And as we heard from Honorable Deputy Governor, Philippines also moved into that regime since last year to 2020, I think. Measuring and reducing financed emissions is another activities the bank will be required to do going forward. Financial institutions are increasingly making pledges to align their portfolios to achieve net zero emissions by a certain date. They have started translating these commitments into targets for sectors and geographies. In fact, the commitment has also come in from the government side during the COP26 meeting in Glasgow last year. Given that emissions ultimately are from the counterparties, financial institutions may find it helpful to support the transition plans of their customers. In fact, in our part of the world, what happens is unless and until banks make it mandatory, the customers, they don't normally respond to any kind of regulatory changes. This is as far as Nepal is concerned, this is what has actually happened. The banks also will be required to rethink for the risk and returns. Some decarbonization projects are likely to have longer than normal payback periods. The possibility may compel financial institutions to adjust their criteria for which projects they finance their projects. Over time, translating these commitments into actions that lower emissions, including expanding the range of climate finance products and services, that is something banks will be required to do going forward. For example, banks will be funding for low emissions power projects, new financial instruments they need to introduce to support negative emissions and nature-based solutions.
Upendra, sorry for interrupting. I'm just conscious of the time. Is it?
Yeah, I'm almost there. I'm almost there. Repayment capacity need to be assessed, also considering assets being stranded, because the old assets will get stranded and then new additional investment will be made, which will be financed by the banks. And control and monitoring mechanism need to be developed by the banking system in order to mitigate the risks and impact. The banks that tackle transition risks as part of the broader environmental, social, and governance initiatives will be better prepared to mitigate the above discussed risks and impacts. In this part of the world, general awareness, this is what I have felt, for climate change is very much a necessity. IFC performance standard could be the starting point for all of us. Banks and organizations lack capacity in terms of understanding the environmental and risk management systems. Capacity building initiatives need to be accelerated for various sectors which are impacting on the climate change, including financial institutions. For example, in Nepal, we are working together with IFC and FMO, the Netherlands-based government owned development bank, for SRM capacity enhancement for the sectors. I have an example of microfinance Nepal initiative. If you could change the slide, please. Next slide. Next slide, please. There were, in fact, I came across one of the example of microfinance institution involved in, transition to low carbon situation. So let me just summarize it. One of the microfinance in Nepal, they plan to launch a project to provide services to 8,000 households. Majority of them are 90% women. 90% of them are women, and that project envisages encouraging members to provide clean cooking solution. And for that, the supplier of electric cooking stove has been arranged. Arrangement have also been made with the supplier for regular and timely supply to provide services for installation and after-sales service for efficient use of the e-cooking stoves. And this, this measure is going to help improve health and health of the rural population, as well as transition to the use of the transition to the use of the clean energies. So without here I just summarize this. The loan being provided by the bank is mere 90,000 for replacement of the equipment for installation of electrical lines in the households, as well as for buying cooking stoves. Thank you. That's all from my as far as I'm concerned. Thank you.
Oh, thank you so much, Upendra, for sharing your insights and for that example in Nepal. And then we enjoin everyone to drop the questions to Upendra in the chat box. And part of the takeaways from Upendra's presentation is really on what can banks do as they integrate and recognize these transition risks in their operations. All right. At this juncture, we would like now to hear from Dr. Jaime Aristotol Alip. We can call him Dr. Aris, as he talks about a case study and case study examples actually of bank responses to climate-related events. So from speakers from Japan and Nepal, we're going back to the Philippines and really talk about these case study examples. Dr. Aris is a poverty eradication advocate, and he has more than 35 years of experience in microfinance and social development. And he's the chairman and founder of the Center for Agriculture and Rural Development, Mutually Reinforcing Institutions, or CARD-MRI, a group of organizations that provide social development services to Filipinos and insurance and insure more than 27 million people nationwide. So very impressive numbers for CARD-MRI. And so with that, Dr. Aris, the screen is yours.
Thank you very much, Marlon. May I request Tintin, thank you very much again, Marlon, to the participants, of course, to BSP, Did Punas here, and of course, the co-organizer of this seminar. I will be sharing to you this afternoon the response of CARD-MRI in climate-related events. I am a practitioner, so I will speak from my heart on what we are doing in terms of calamity or climate-related events. Can I see the next slide, please? Next slide, please. Okay, I will not belabor too much on the Philippine context because this has been explained by the first speaker, that Philippines is actually the typhoon capital of the world. You have around 20 to 21 typhoons every year, and it's becoming very devastating every time. But just to point to you, always heat is in the Visayas areas, Northern Samar particularly, and Leyte, the Bicol region, and of course in Northern Luzon, Baguio and Benguet. The annual rainfall from 2014 to 2018 is around about 169 to 242 millimeters. Risk modeling estimates from earthquake annually is about 43.5 billion or $1 billion US dollars. Tropical cyclone 133 or about 2.5 billion US dollars. I will not anymore belabor on Yolanda, but I think this has been discussed by the earlier speaker. It wreaked havoc, damages in infrastructures, billions and billions of pesos and dollars have been spent over the years. Many are still recovering. Lives of more than 6,300 people have been lost, including CARD. CARD lost about 503 dependents, members, and children and clients of staff in Leyte. Next slide, please. Of course, we know already drought, fire, earthquake, volcano, floods, you name it, we have it in the Philippines. That makes Philippines very exciting. Next slide, please. Okay, let's talk about the effects of climate-related events of operations on operation and risk management of thrift banks and rural bank. I think most of you are practitioners attending here. You will realize that the increase in deposit liability, people tend to withdraw, hold on to their money in anticipation of expenses for reconstruction and emergency. This is human behavior. They want to protect their family first, and of course, the basic need. You will see the rising NPL, the non-performing loans. Of course, the human behavior, people will tend to spend more on urgent needs rather than paying their loans, especially when you're talking of microfinance and SME clients. Decrease in profitability and return on asset. Decrease in loan portfolio because financial institution, especially microfinance, banks, cooperative banks, they're becoming risk averse. So they are afraid to give loans, extra loans, especially if there are calamities. But I defy logic, which I will share to you later on. The more calamity, the more problem, the more I will give loans. Increase in non-interest expenses, of course, because of infrastructure, properties, and damages. Banks and organizations have to rebuild their facilities, equipment, and buildings. And of course, also the properties. Next slide, please. Now, I'd like to focus now on the experiences of card MRI as a practitioner. Card MRI, as you can see in the slide, is composed of 23 subsidiaries, mutually reinforcing institutions. We are grouped into several categories. We have the banking group, the microfinance group. We have the microinsurance group. We have our own IT group that propel our digitalization within the MRI group. We have our own health group. We own hospital, clinics, and pharmaceutical company. We also own our educational school. We have a college, and we also have our publishing company. So these are the groupings of our different subsidiaries. With the end in view, we want to eradicate poverty in this country. We're not really in the business of banking per se. We're in the business of poverty eradication. So this one is very important to us, this climate related events, especially when you talk about the clients. Let's look at the next slide, please. Now, this is our operational highlight as of December 31, concluding in 2021. This is the banking group and the NGO microfinance. You see, our total outreach is almost 8 million clients, and these are normally the informal sector, the agricultural sectors, micro entrepreneurs, and small businesses. We are dominant and have 80% of the entire microfinance in the entire microfinance industry. We're insuring about more than 27 million insured individuals. This is in fact the largest in terms of outreach of microinsurance, as we're now reaching about 60% of the entire insured Filipinos at the lowest sector. Our total loan outstanding is about 34 billion, more than about $700 million in terms of loan outstanding. And mind you, our repayment rate has been maintained at near perfect rate despite of this COVID. Our savings is around 31.23 billion. Sometimes our saving is more than the loans, and our offices around the country is around 3,400 offices and units and branches all over the country. We're present in 85 provinces, including NCR, 97% of the entire cities and municipalities of the country, and 96% of the entire barangay in this country. That's why when there is a calamity, whether this is earthquake, fire, typhoon, we will surely be hit. We're operating this banking group We own 3 banks. We have the card bank that focus on the rural area, the RBI that focus on the urban area, and those who graduate from the microfinance who become SME will move to Card SME Bank. And then we have the Card Inc., the microfinance NGO, which is our trailblazer, and they are the one going to the hard to reach areas. We're also operating in several countries, 6 countries in Southeast Asia. You have Vietnam, Cambodia, Indonesia, Laos, Myanmar, and Thailand. So what I'm speaking of also shares the experiences that we have in these 6 countries. Next slide, please. Okay, in terms of the effect of climate events, operation, and risk management, from a practitioner point of view and from Card MRI as a case study, of course, there will be an increase in portfolio at risk as the business are also affected by disasters. Our recovery of the members. Yolanda alone, we have about 180,000 members who were affected. And our PAR, surprisingly, is not so high. It's about 24 million pesos. And we were easily able to recover this because of the discipline of our microfinance client. Odette, the recent typhoon 2021, this has been mentioned by DG Punasher. We have around about 265,000 members that were affected, and portfolio at risk because this is quite ranging in Visayas and Mindanao, and it affected about 82 million of our portfolio in terms of risk. We spend a lot of funds and cash in the impact on the damages on the building and electricity, and of course the connectivity disruption. But because of our microinsurance, this has minimal impact to us, which I will discuss with you, which is very important in our discussion. Next slide, please. Now, talking about what are the initiatives that we are doing in terms of the climate-related events, because as I've said to you, we are present in the entire archipelago of the country, from Batanes down to the Tawi-Tawi in Sitangkay, the farthest town in the country. We're present there. It's about 30 minutes. You're already in, by pump boat, you're already in Sabah, Malaysia. This is what we do in terms of the disruption. These are the effects. It's affecting our fund management. In terms of clients being affected for the last 10 years, it's 893,000 clients, and our loan outstanding that has been impacted is more than 163 million. And so total savings that have been withdrawn, these are bolts, nuts and figures, it's about 197 million, 197.5 million. Okay, next slide, please. Okay, what are the actions that we are undertaking to address all this and mitigate all these concerns on climate event? Next slide, please. Okay, as I've told you, because we're present in the entire archipelago, we have developed our own disaster preparedness modules. This is, we call this the credit with education. So in here, we have the disaster preparedness education program. If there's a typhoon coming, we will ensure that our clients are briefed and our staff knows what to do, so they are prepared. So most of them do not have to go into rehabilitation center. They don't have to go to other areas because they're very prepared. We also have an insurance awareness program. And because we are very highly organized at the community level, we're organized, our clients are organized into several centers wherein we have weekly and monthly meetings. That's where we're able to provide the credit with education. So even rainy days, what are the sickness that the clients will possibly have? So these are also our mitigating measure. Even this COVID-19, we have this credit with education program, so they know already what to do. We have a radio program under our Facebook, and we're able to do this twice a week. We also have trained our staff in terms of first aid and stress debriefing. We have our own disaster management committee from the top level down to the field level, so that this become responsive to whatever the clients need and our staff requirements during typhoons especially. Next slide, please. Now, we also do, in terms of typhoon normally, or in terms of earthquake, we have our own relief operation. In our relief operation, we have what we call this disaster response relief assistance. For the past many years, past 10 years, cumulatively, because of typhoon, for the past 10 years, we have about 3 million members that have been affected all over the country, and we were able to give relief assistance of around 560 million pesos. So these are food packs that we are able to give to our clients, because we need to give them food first, because we're talking of the poor in terms of our target beneficiaries. We're actually one of the first responders when there's a typhoon and when there is a calamity. Next slide, please. This is very important because our clients have this provision for microinsurance product. Our clients have life insurance, loan insurance. We also have the disaster insurance under the SAGIP plan. If the typhoon hit their houses and it's insured, then we pay also the damages. We have the healthcare insurance under this COVID-19. Many of our clients are getting sick, so they can also get our health insurance. We have this Protect Kita, which means this is our own version of business interruption insurance. This is very important because our clients are able to make a rebound quite easily, so that when there is business interruption because of calamities and events, we're able to pay and they are insured. And then we have our own version of agricultural insurance called Binhi Crop Insurance. So this is very effective. The premium is very low. And our distinct difference from the rest of traditional insurance companies that we're known as the 135 institution. If there's a claim, we can pay the claim in 1 day. If there's a question, 3 days. And if there's still documentation required within 5 days, with finality, we will make a decision whether to pay or not. But because of this digitization, we now have up our standard. We're now the 824 microinsurance group, because within 8 hours, we can pay the claims, and up to 24 hours because we can use the cell phone, we can use all kinds of channel to make the payments. Next slide, please. We also, just to show to you the numbers in terms of the provision of microinsurance for this property, you can see here the calamity aid, the calamity insurance this is where the typhoon is hitting our clients. So their houses are already insured, lives are insured. If there's accident, there is also what we call a crop insurance. So for the past 10 years, 403 members have been insured, and we paid around 1.3 billion. They don't have to go to government. They don't have to go to the LGUs to ask for charity. Because of our microinsurance, they are able to resuscitate right away. Because of our system of claims payment, 8 hours we can pay. In 24 hours with finality, we will be able to pay. So this is very important in addressing climate-related events. The microinsurance is badly needed, especially when you're dealing with the poor and in the rural areas. And this is very important for the banks and also for financial institution. Central Bank, BSP, has been very, very good in terms of policy support in making sure that the banks can also sell the products of microinsurance. You just have to get their approval. Next slide, please. For banking operation, of course, we have our own business continuity plan. I think all banks have this because this is not only a requirement, but this is very important in our operations, especially if there are calamities and climate event problems. We ensure daily transaction, weekly backup, because we're now, and we have shifted to digitization, so to speak. We have the recovery site located in strategic location. We have a joint venture. We have a very strong IT group, and we have a very good joint venture here. Next slide, please. For banking operations and also our microfinance, we also declare loan moratorium to affected clients. This is very important. Some traditional bank, when there's calamity, the more they will collect. For us, when there is a problem, we try to help the clients, especially these are the very poor in the sector. We try to help them. We don't give them more problems. We help them. So we give them more loans, special calamity loan, so that they can be able to resuscitate their business, give back their business. So slowly they can recover. And surprisingly, after a month or so, our clients are able to recover, so that our portfolio at risk becomes lower and lower. We have availability on staff to assist the members in terms of financial transaction. So if there's damage, if there's no electricity in our branches, we have several units and branches which our clients can go to, and we can direct them to go to. So we can do this. Next slide, please. Okay, now I'd love to share this, the green financing, renewable energy. What do we do now to support this green financing? In terms of green financing, CARD is already doing a lot of loan program. We have the solar energy that we can give access to our clients, electricity. These are very crucial, especially in calamity time. We have been pushing tree farming, waste management. These are some of the few green financing program that we're now currently doing. I like and also pursuing the agricultural project. We have a very good partnership with IFC, because I want to give credit to them also. They have helped us in this agricultural program. It's very good, the technical assistance support. So under this program, we're able to push agriculture, the value chain, and ensuring that this is climate friendly. The other thing that I'd like to emphasize also is that, you know, that there is now a shift from rural agriculture to urban agriculture. You see, this is also the positive impact of COVID-19, because the urban people are now doing greening of their backyard because they're also planting vegetables. So this is also very right and very simple. And CARD is supporting this. We have what we call Luntian ni Nanay or Kawayanan ni Nanay. So this is very sustainable projects. So in our own little way, we are able to contribute. We're also, through the center meetings, encouraging tree planting for all our centers. We have around the 8 million clients all over the country, and we're pushing 8 million trees a year. So this is how we want to help the community in the Philippines. Next slide, please. And this is the last slide. Thank you to the government, but I hope they can continue in bringing capacity building and promotion to financial institution about this climate related program. DBP has a very good program on green financing, Land Bank also, and other commercial banks. So I think this is good. I like what BSP is doing. I think DG Punasher also articulated this, the circular 1128 of BSP. I think this is very helpful. And I'd like them to continue mainstreaming the governance standards through the issuance of supportive regulation. Thank you very much for listening.
Thank you so much, Dr. Alip. Very, very comprehensive and insightful as well, and really great to see your response, your specific responses. So the three things that popped up really were, the declaration of your loan moratorium, the provision of special calamity loan, and accessing the TA support from the likes of IFC, for example, to support green financing. Those are three of the many things that you've done in response to these climate-related risks. So thank you for sharing your insights and this case study of your your responses for a long time now. So I know that we're already beyond our allotted time of 90 minutes, but I think we can stay for a bit, like maybe 15 more minutes to answer some of the questions. And we do have some questions here in the Q&A box to kick off some of the discussions. One of the first questions that were sent is addressed to Upendra. What are the examples of transition risks as the economy shifts to a less polluting and a greener economy? And Upendra, you'd like to answer this live? Is Upendra there? Otherwise, we can go to one of the other questions.
So, sorry, I was muted. Sorry. Hello. Yeah.
Yes, Upendra. Kindly hear your answer and your insight.
Various examples of climate related risks are basically the customers. As far as our banking system is concerned, the customers' position because of the climate risk, climate change, is major is the major risk. In fact, because of this, as we discussed earlier, because of the policy and legal changes to shift to the carbon-less economy. So we need to, the customers are exposed to the risk. So because of the policy and legal changes, the customers are exposed to the risk, and that is where we need to manage, we need to analyze, we need to measure. And those risks, the policy risks are basically, there will be GHG and increased pricing of the GHG emissions. And then GHG emissions reporting obligations will also be there for the customers and even for the banks. And there is a major risk is from the technology changes, actually. When we move from the fossil fuel regime to the carbon-free kind of regime, then we need to invest heavily in the technology. And then if you are not in a position to keep pace with the changes in the technology to reduce the carbon, then you are exposed to the risk. And if the banks are financing those type of customers, then the banks are exposed to the risk, and that is where we need to sort of step in, and on a timely manner, we need to educate the customer, consult the customer, counsel the customers, and ask them to change the technology and be aware of the legal changes, the reporting requirement changes, and in fact, the market, there can be demand, there can be changes in demand of the products of the customers, and even for the banks, if they are not in a position to adapt to the climate change situation, then the regulatory fines could be there. The litigation could also come up. And again, finally, the reputation is something which we need to be aware of. If the reputation, if it impacts on the reputation of the banking system, then that's where that's the foundation of the banking system. So
Okay.
those are the risks we are exposed of.
All right. Thank you so much for sharing your thoughts to that question, Upendra. And I think this one of the questions is addressed to Firdaus. In engaging with investors and asset owners, especially on topics related to is it a responsibility of emerging market investors or or financial institutions to be at the forefront of climate? How do you frame the discussion so that concerns about like what should we do, how should we tackle the challenge gets framed in a productive way? Firdaus, do you have thoughts on how has been your communication on questions about the level of responsibility and the level of action that that needs to be done, especially in an emerging market context?
Okay, thank you. I think for to answer from emerging market perspective, I think it would differ by because, like, for example, if we talk about Asian market itself, different markets from, I mean, Asian markets is very vast and big. We consist of several different markets that actually behaving quite differently. Like, for example, if we talk about China itself, or maybe if we talk about Japan, and then we talk about Southeast Asia, it's all behave differently. So I think I could answer that in terms of how we engage investors in the region to build the capacity on, for example, in tackling climate risks in their portfolios. So it includes a lot of ways. I think the first important things is to make sure that the knowledge is there. Because sometimes, like, there's a lot of knowledge available out there, but it doesn't reach the right targets. Like, for example, some investors in Asia might not know that that the availability of knowledge and tools from different regions maybe could be applied in their markets as well. And there's also that potential that they could learn with those capacity in other regions, for example. So I think it's important to connect those to these investors and make sure that they're aware and they build the knowledge. And from there, I think from the awareness and from knowledge, it will connect on how they can, further tackle the risks. Like, for example, I see some questions about climate risk and how it can impact the banking industry, and for example, so those are the kinds of things that awareness, I think, is the first thing that's very important, and then build the knowledge from there, and then it's then started, to build the way of tackling the risk and handling it in a better way.
Okay, thank you so much, Firdaus. And I think the main takeaway there is to access all the information that's already there. The science is clear. The frameworks by which financial institutions are exposed and are responding are clear. And if we look at this at the lens of opportunity rather than a burden, for example, the IFC has estimated that it's a $23 billion opportunity in emerging markets alone, then it's something that could expedite action. Especially that we are engaging with rural community banks and thrift banks in this convening. While we recognize that, Dr. Aris, it's great that we recognize the government via the Green Force and BSP's continuous actions on this in this space. For example, undertaking capacity buildings and continuous mainstreaming government standards. The question is, as SME banks and smaller banks, community banks, thrift banks, what can they do truly, and can they do tomorrow or in the short and long term to contribute towards what the government has already set out to do? For example, reducing carbon emissions by a percentage at a set date. What can the smaller banks do in the short and long term to contribute further?
Thank you, Marlon. As I've said in my last few slides, I think the green financing is very important. ADB has this, and I think Land Bank also has this facility. And we can push the solar energy. These are very simple things. Waste management, tree farming for agriculture. I think these are very good. And this can be easily done by banks, thrift banks, or even the cooperative banks, because if you're dealing with farmers, they only have about half a hectare, 1 hectare. So these are just very not so big in terms of amount. Or sometimes they just put it in the fence, like planting mahogany, mulabit tree. So these are very good. The other thing is the agricultural financing. I think this is crucial because we need food. I think this is a sunshine industry in the country because I think with this COVID-19, it's a wake-up call for us. As I've told you also, there is now a shift from rural agriculture to now urban agriculture. So you can see greening also of the urban areas. And also what is surprising is that many of the youth are now becoming interested in agriculture because of this gadget. So they're able to combine this gadget and this technology for agriculture. And I've seen this, and we're funding a number of youth leaders doing agriculture. So these are very helpful in climate change. But again, I'd like to push the idea that in this climate change, when you're dealing with, especially for my colleagues in the banking community, especially rural bank and cooperative banks, I think it's important to push microinsurance. This microinsurance, we have this disaster insurance, we have this business interruption insurance. But Marlon, one of the things I've been pushing is that in terms of agricultural or this non-life insurance, I think the premium tax is so high that it is about 26 to 27% in terms of premium, which means for every peso, the premium tax that goes to the government is actually 26 to 27 centavos already, compared to a life insurance, which is only about 2%, which means for every peso, only 2 centavos. So if you're dealing with climate change, and Marlon, I hope this can be articulated, no? We need this kind of policy advocacy. The Insurance Commission is very supportive. We will have to work with Congress that somehow this non-life premium tax should be reduced, just like in other countries, because in other countries, the maximum is only 5% in Southeast Asia. Ours is very high. Now, how can you make the private sector move into this kind of space if the tax is very high? And if you're talking of the poor and agricultural insurance is a non-life insurance, so premium tax is very expensive. That's why we have to come up with our own. So Marlon, I just want to articulate that as a matter of policy advocacy. But I think I'm embarking on more on the Congress, because this is not really on the regulatory body. BSP and as well as Insurance Commission is very supportive with this idea, but I think it's a law that needs to be addressed.
All right. Thank you so much, Dr. Alip. Apart from providing products for solar and agri, it's really building a coalition around advocacy, policy advocacy for these kinds of non-life insurance and micro insurance products. So I know that we're well over time, and at least we would like to convey that we will send everyone an email summarizing the takeaways from this convening. And we will also include the presentations from our speakers. Those the questions that have not been addressed, answered live or via chat, we will endeavor to answer them separately and get the expert insights from our resource speakers, and we will collate them all in an email to everyone. So we have covered, we've spent the past 90 or so minutes and went well beyond time to talk about the 101s, like the basic ones on climate-related risks. I know that the conversation will still need to move ahead, and we hope to engage with you and talk to you again as we have a follow-up conversation on taking off from these topics, right? Like maybe we would like to talk on how to build capacity to identify, measure, monitor, and control the risks related to climate. Maybe we will talk about how to make sure that there's inclusivity and inclusion as we embark on our different climate-related responses as financial institutions, or things that would be very much helpful to you as banks in this space. So we truly thank you for joining us and staying put, and we would like to acknowledge again our expert panel of resource persons, of our fantastic speakers, Mr. Firdaus Anwar, Mr. Upendra Pudyal, and Dr. Aris Alip for spending their time with us. And to the Banko Sentral ng Pilipinas, to the team of DG Chuchi Fonasher, Assistant Governor Lynn Javier, to Ma'am MC Desquetado, Ma'am Beng Brazil de Vera, and Ms. Juvie Rosales. Thank you so much for helping us convene this conversation, and we look forward to welcoming you in a follow-up webinar. With that, thank you so much. This is Marlon Apanyada, and we look forward to capacitating you and helping you out in your respective climate journeys. Thank you very much.